Hi, Christian. How are you? Nice to see you.
Good to see you, Bogomil. I'm doing very well. How are you?
I'm doing very well. Our paths crossed, I think, a couple of times, and I think we were not aware, only we found out later. So I'm glad we were able to connect today. I know you were in the room when I was giving a talk in Zurich this summer, and here we are talking about what you do in your life. And I have so many questions, but I always like to start those conversations with the early days, your childhood and upbringing. How do you think that time influenced you today, your career, the choices you've made since?
Yeah, I think it's a very good question because I certainly think it has had an impact and has shaped me, as a human being and as an investor. So I grew up very far from financial markets and from the big cities, right? So I grew up in small town Sweden, and the my parents were not, in the context of investing and my interest in investing. My parents weren't investors. They were not they were never sort of part of that world. We had a family business, and I think that's an important influence. I think that shaped me in many ways. Hearing all these conversations about what it's like to operate a business as opposed to be a passive investor in listed companies. But it was a great place to grow up in a general sense, and because it's the kind of place where you have so much freedom that you may not have in a big city, and
Hmm.
it's a pretty quiet environment to grow up in, which suited me very well. Yeah, I had all the usual interests, sports and music, and investing came into it much later. So I grew up there
Hmm.
with my parents and my sister, and they still live around there, around that part of Sweden. So I still feel a very strong connection, and I go back. We have a place there. I go back there every few months to see them and see my old friends up there. So I think it's been an important influence.
Do you have some memories of your early relationship with money?
I think the first time I became aware of money in an investing sense,
Hmm.
I was probably 16 or 17, and my parents encouraged myself and my sister to, they wanted us to learn how to invest responsibly. And so they gave us a small pot of money to invest, and this was in the mid to late 90s, in the sort of dot
Hmm.
com bull market. So it was a very, I think
Exciting times.
it probably it was very exciting, right?
Hmm.
And I think in a way that kind of market didn't suit me or my temperament at all. But equally, it's probably a good time to get into it, in the sense that there was the excitement, and
Hmm.
it seemed like so much fun, right?
Hmm.
I didn't do very well, but I think they actually framed this as some sort of contest between myself and my sister, and she did much better. And I think I was too, already back then, I was probably too sort of prudent and conservative. But that's how I got into investing. So I started investing in listed companies, for my own account in my
Hmm.
sort of mid teens, I guess, or late teens. And that excitement just immediately made me realize that this is probably something I want to do. So that sort of shaped much, or most of what I've done since, in a professional sense. So that's probably my first recollection, or strong sort of recollection of having a relationship to money and investing and all these things.
I had a conversation with Daniel Crosby, who studies investor behavior, and the interesting point that he was making, the time when you join the world of investing, whether it's a bull market or a bear market, has a huge impact on how you see the world. And
Yeah,
you
I
mentioned
think
that you
that's
were
right.
conservative, cautious, and prudent. Can you tell me where it came from?
Well, first of all, I'd like to think I'm all those things. Someone else should probably answer that question, but I think that's fair to say. I think it's partly, of course, a personality thing, right? You look at your parents, and
Hmm.
or I should say, I look at my parents and I recognize some of these characteristics. The prudence,
Hmm.
worrying about not losing what you have, and downside protection and all these things. And then I'm sure it's also the environment, of course. Like we said, I think the environment where I grew up was much more of a sort of, it's a pretty industrial kind of place. And I think in a way it means that you have less of that financial mindset, if that makes sense, right? So I think the environment
Hmm.
probably shapes that as well. So as usual, it's a bit of both, I guess. But now I just feel it's so ingrained in, that's who I am, and I think the longer you invest for, the more you realize, and I keep hearing this from people who've been investing for a long time, that
Hmm.
the more you realize that the way you invest is a reflection of the way you are or who you are, and then I
Hmm.
guess over time you also figure out what works, partly by looking at other people and what works for them and what doesn't work for them, but especially looking at what works and what doesn't work for yourself. So I think it's probably a bit of all of those, Bogoma.
It's interesting. I call it a deeply rooted risk aversion, but I think a better word for me personally would be awareness. That I'm just
Yeah,
aware of the risks. I want to be aware of the risks,
yeah,
and I think people get into investing to make money, and they get
yeah,
into investing to make money quickly because it seems very easy and simple, and everybody can click and buy. But people that actually stay in the business decade after decade, and I'm sure we'll talk more about it, a different set of qualities prevails, and one of them I think is that kind of risk awareness that you could lose money, and what are you going to do about it? I'm curious about the type of investing you end up choosing. I see that you're leaning towards value investing. You appreciate the value of the business you're buying. How did you discover that kind of investing? Because a lot of people, when they initially get into investing, could be momentum, could be other things, but somehow you gravitated to a certain school of thought.
yeah. Well, I think first of all, I would, I probably feel that I would probably label it quality investing, or right. There's certainly a valuation discipline in there somewhere, but I think for me, it's not value investing in the traditional sense or deep value investing, right? So it's, but if you're, referring to the sort of set of principles and values of value investing and people who adhere to that, yes, then I'm certainly part of that community, I think. And I don't necessarily think I invested like that or thought like that when I first got into investing in stocks when I was in my mid to late teens, right? So like most people, I probably didn't have a very good sense in general of what I was trying to achieve or how to go about it. I didn't have a very clear investment philosophy. And this is something I say to students myself these days, or when I have
Hmm.
interns, I always say to them, you probably want to start very broad. You look at all kinds of things and all kinds of situations and industries and geographies, and then that's the only way to figure out what your style and philosophy is, right? You can't have you can't know that when you're 20 or 25, and in fact you can't know it, you don't necessarily know that when you're 45 or 50 or 55 either, right? I mean, it's a constant work in progress. But I think one reason is why one of the reasons I've sort of evolved into that type of investor is it suits my personality, right? My temperament, my
Hmm.
interests. I think that's a very important part. You need something that is sustainable. And I think for it to be sustainable, for me to be able to sort of stick to the philosophy, it needs to feel natural and in some ways obvious.
Hmm.
And I think for me, quality investing just has that. There's some sort of obviousness about it, if that's the right word. And maybe it's partly because of growing up in a family where there was you know, there were conversations around operating a business.
Hmm.
Um, so that's part of it. I guess the other part of it, or the other reason I ended up in that sort of, in that group of investors, I think is because I've seen it work for myself and for other people. And so, 5, 10, 15 years into your career, you look at what have I done historically that has made me money and vice versa. And for me, it's usually been the good businesses.
Hmm.
So I think they're the two key things, right? Number one, it suits me. I feel comfortable with the idea of owning great businesses, and two, it seems to work. But I'll be the first person to admit that there's other ways of investing, and in fact, there are other ways of investing that will probably, provide more upside in the short, medium, and even long term.
Hmm.
So I'm not necessarily looking to optimize here. I'm not, I'm not trying to fool myself into thinking that I'll be doing 25 or 20% per year for the next 3 or 4 decades doing this. But equally, I can probably achieve a level of returns that I think are satisfactory, and I can do it for a long time, and it suits me and I enjoy it. So all of these things come together, don't they, in terms of finding your own style, finding what suits you, and then it also works in terms of achieving the goals I've set for myself in terms of return levels and risk and downside protection. I think owning these great businesses, will hopefully allow me to achieve all these objectives. So there's so many aspects to it, right? And there needs to be a coherence between all these things. And then I have a structure where I think I can do this, as in I have permanent capital. I feel that sort of allows me to be invested in these great businesses over time. If I was
Hmm.
managing institutional money, I used to work in that environment. I might feel more pressure to, keep up with the market over 3 or 6 or 12 months. So I think there's so many. I know it's a very long answer, but I think all these things come into it.
I like what I'm hearing, and I like that aspect of finding what works for you.
Yeah.
And I agree that there are probably 1,000 ways to make money in the stock market, probably 1,000,000 ways to make money in general. But you have to find a way that works for you. If you are investing the way that creates some sort of a friction and dissonance with your personality, it will catch up with you eventually in some way. So I think being really honest with yourself, what's the investment style that works with you? And I like
And
the idea
and
of, go ahead.
and sorry to interrupt, Bogomil, but I should say I agree with what you just said. I think it's especially important when things aren't going so well, because of course
Hmm.
when things are going your way, it's easy to stick to whatever discipline you've adopted. But I think the challenge is, well, what if the market goes against you, whatever that
Hmm.
means? That's when you really need to have conviction and a very sort of deep, deep sort of belief in what you're doing. That's what I found whether it's a market sell-off or company specific issues. But and
Hmm.
that's why I think often for young investors or people who haven't been around for more than, if you haven't seen a few cycles, I think it's very easy to sort of get into this false sense of comfort, right? Where you think, well, whether it's momentum or deep value or, this seems to be working well, I'll keep doing it. But
Hmm.
I think you need to ask yourself, well, how will I behave? How will I sort of react when things go the other way?
Very much so. And both in a bear market and a bull market, an investor gets tested. In a bear market, will you hold on? I just had a conversation the other day with an individual investor who was sharing a story how he was experiencing a lot of emotional distress in March of 2020.
Mm,
But then I think people experience distress later on during the bull market when their neighbors were getting richer faster than them. I think that really
yeah,
got to a lot of people that I know and I respect. And I noticed that
agreed.
even very seasoned investors were giving in to this kind of, I guess, FOMO, fear of missing out, whatever that was. But I think it clouded their vision for a minute, and they started to experiment with asset classes and investments they wouldn't consider otherwise. So it's a very emotional journey, and being really honest with yourself. What's the style? What are your goals? What are you trying to achieve? And at the end of the day, I like the idea of a quality of sleep. If I can't go to bed with the holdings that I have, then there's something off, and maybe there's something I shouldn't hold. And it's been a wonderful test for me that I'm not going to hold anything that can keep me up at night. I don't think it's worth it. It's not going to help me. I want to
That's an
dive in
interesting
on the. Go ahead.
point. No, sorry, I should just say that's an interesting point, because of course there are those investors who argue you should feel uncomfortable, right? You should feel, when
Mm-hmm.
you make the investment, the best investments you'll ever make are probably those that make you feel slightly or even significantly uncomfortable. Some people even want to get to a point where they feel almost sort of physically sick from the experience. But for me, that just doesn't. I think I tend to shy away from those types of situations. But of course, there is a school of, more sort of ballsy, brave, courageous kind of school of investing that advocates for that. It doesn't suit me, and I also wonder about the life expectancy as an investor if that's how you operate.
No, that's very true. So it doesn't work for me. It may work for somebody else. But on that note, I wanted to mention that, I remember sitting in a bigger room and pitching in ideas at junior analysts years ago. And I always thought that the best ideas were the ones that many people felt uncomfortable with, or they were not that
Yeah,
obvious and they were harder to
yeah,
process. But I knew enough about them to have conviction.
yeah.
And these were the best ideas. So if I was still uncomfortable with that idea after doing all the work, for me, it would have been a red flag. I don't know if it's a red flag for everybody. For me, it would have been. But
Mm,
that the audience disagreed with me, that actually had the opposite effect. I thought I found something that a lot of people, for some reason, are missing out on. Now, if I had an opposite situation and everybody loved the idea,
mm.
I thought it's probably in everybody's portfolio, and I don't think I found anything that stands out. So I think it's a dance. It's a fun experience of what kind of feedback you're getting, and obviously who's in the room, right? I mean, who's listening to you?
I, I agree.
Yeah.
I agree with what you said. I was just going to add. I guess it depends on with whom you're having the conversation, because there are some people with whom I may sort of discuss some of my holdings, and they may take the opposite view, and there are some people where I feel that makes me somewhat concerned, because I know that they do a lot of very detailed work, and I feel that they're very smart people, and
Mm-hmm.
or maybe an industry that they're very close to. So I think it's important to sort of be aware of whose view are you sort of taking the opposite side of here.
Mm-hmm.
But as in a general sense, I agree with you. And I guess that's a sort of personality thing, isn't it? That both of us
Mm-hmm.
seem to be attracted to situations where you don't want to get into consensus type situations. I should say many of the holdings, or probably most of the companies that we're invested in, I think many or most investors would agree that these are good to great businesses, with some exceptions.
Mm-hmm.
But for me, it's more a question of when do I buy them. So I don't
Yeah.
necessarily go into these, call them battleground stocks, right? But when I do go into something, I prefer to try and buy it at a time when most people aren't perhaps so keen on buying. So
Mm-hmm.
say, you mentioned March, April of 2020. That's one example of when I've added significantly to some of these holdings. So it's not that they're contentious, I think, stocks or companies as such, but for me, it's more a question of when do I buy or when do I add to them.
It reminds me of a conversation I had with a client years ago, and he at the time had an account with another firm that eventually ended up with us as well, and an
Mm,
account with us. And he was looking at the two accounts, and he says, there's an overlap between what you're doing and what the other person is doing, but you're buying those stocks at a different time. And I said, tell me more. And he says, well, he's buying them at an all-time high every time, and you
yeah.
seem to be waiting for the moments when they break. And obviously the returns looked very different at the time, at least. And I thought that there's a lesson there. So when you look at somebody's portfolio, it's not just what is it that they hold, when did they
Yeah.
buy it,
Yeah.
and you can
Exactly.
you can overpay for the greatest business. I mean, I have
Yeah.
seen some incredible businesses. I call them those moments when they have to grow into their valuations, right? So if you
Mm,
buy something at 100 times earnings, this will trade eventually at 20 times earnings. But that journey, the business will grow. But at the
agreed.
price level, you might be exactly where you started. I mean, are you
Yeah.
are you ready for it? Right? Like that's something that people should consider for a
And
moment.
and I should say I've certainly been guilty of that myself, as in overpaying for what I think are great businesses. I think I'm getting better at it, but that's certainly still that's probably one of the key risks when you invest the way that I do, and perhaps you do, Bogomil, that you see these great businesses and you need to be very sort of patient and disciplined. And I think especially when you've had a period like the last 10 or 12 or
Mm-hmm.
14 years now with a few setbacks. But on the whole, these types of businesses, certainly until 18, 24 months ago or something,
Mm-hmm.
the sort of long duration, high growth, high quality kind of businesses that I think both of us are attracted to,
Mm-hmm.
generally speaking, we had such a long run of very strong performance from them that I
It's true.
think, I also, even if I'd been investing for a number of years before that run started, I think there was always this sense that, it's never the wrong time to buy these businesses. But I think, in a way, I think it's been a healthy shakeout in the last, say, 18 to 24 months, in that, I've also been reminded that if you buy these great companies, when the
Mm-hmm.
valuations, and often I find that earnings and multiples tend to be high both at the same time, right? So you get the double whammy when earnings disappoint and the multiple compresses. And I've had a few of those in the last 1 to 2 years. So I think, and that's part of still refining your approach and your process, isn't it? That I think I probably pay more attention to now when I buy or when I add to these things.
Well, a couple of thoughts come to mind. One is that I like to do things gradually, unless it's a
Yeah.
March
Yeah.
2020 kind of moment where I know I have to act quickly, right? So it's
Agreed.
kind of a dichotomy of being extremely patient and then extremely fast if the window of opportunity arises. And obviously, March of 2020 was a one of a kind experience. I'm sure we'll have more of those in a different context in the future. There's no question that it will repeat
Yeah.
in some way. But then you have individual stocks that correct quite a bit here and there. I like this exercise of taking any company that you like and looking at the price range for at least the last year, 52 weeks, and then the last 5 years. And I think a lot of people are surprised that those companies have traded in a pretty wide range. And I'm not just
Yeah.
talking about the last 12 months, but any period you would look. And there's
Yeah.
always a range. And I'm always intrigued about that time when something was trading 30, 40% off. I mean, not 80 or 90%, but it was down 20, 30%, even a quality name. And I like to look at the context and what happened. And usually you realize it's either a self-inflicted wound, maybe it's a sentiment shift, maybe it's concerns about the macro backdrop, maybe it's a missed earnings, delayed product launch. I don't know, maybe some concerns about management shift. The list is endless, but I see these as it's not a permanent damage to the business. It's something that will go away, but creates a buying opportunity. So if I can do it gradually, I think I have lesser risk of overpaying for a business.
Yeah.
And it's almost, I like to call it, I want to be the least wrong.
Yeah.
I don't have to be right all the time. I want to be the least wrong. And I think a lot of people get into investing, and I think many other fields, to be right or to prove other people wrong. That's not my goal. I completely forget the rest of the world. I'm thinking just about what I'm trying to do. And I want to be the least wrong. And you talked about survival and stamina and sustainability. But if I can avoid a massive permanent loss of capital over
Yeah.
decades, it's what Charlie and Warren call getting rich slowly.
Yeah.
I
I
might
agree.
be one of very few people left in the room still
Yeah.
doing it, just as they
No,
were.
I agree.
They
I
are.
I very much subscribe to that view. Of course, I also, and as you mentioned, I also like the idea of, unless there's a big, market sell-off where you think you need to act fast. But usually in the kind of examples I mentioned, where perhaps I probably overpaid on the way in, and if we go back 24 months when some of these great businesses were trading at very high levels. But of
Mm-hmm.
course, I started small, so maybe I started at 1 to 2%, and then I've added to that. I do have to say, though, over time, I find that I prefer buying these things when there's a broad sort of market event,
Mm-hmm.
uh, as opposed to the company specific issues that come up from time to time. I just find that in most cases it is much harder to assess whether the business has actually permanently changed or been impaired when there's a company specific issue. Sometimes it's obvious, but more often than not, I find that the general market sell-offs or the rotation,
Mm-hmm.
move that quality to growth to value, or vice versa, or for whatever those labels mean. But I find that they're more sort of, they're better environments for me
Hmm.
to be looking for these great businesses at fair or better prices. I don't know if you what your thoughts are there,
No, no,
whether you sort of get
I
involved in company specific sell-offs or whether you prefer the market ones.
well, it's more of what's available, right? So the macro, it doesn't happen as often and as deeply
Yeah,
as company specific issues. So that's one thing. Now it's really case by case. I'm not talking about a severe deep turnaround where I see, look, the original product doesn't work, they have to reinvent themselves,
yeah,
rebrand them, maybe even rename themselves. That's too much for me. And if it comes with a debt restructuring and a complete shift in leadership, that's too much, right? So that's not the kind of situation I'm excited about. It's more of, it was a steady course, things were working out. Look, the last product launch was delayed and the market is very unforgiving and the stock is down 20%. I'm not going to mention any names in this conversation, but there was a company that makes coffee makers in the US and they had a product recall a while ago now. I want to say 7, 8 years ago. And the stock went down 50, 60%. They had to clear the shelves and they took a loss. They had to fix it. It was an easy fix, but it had to fix it, ship it back. There was probably a couple of quarters that looked awful. And the
yeah,
market was very unforgiving. But I knew the management, I knew the company, and I knew that what the fix is. And I had good, it's also always a very personal assumption. There's nothing, there are no guarantees. But I thought I knew enough to give them a chance, right? So this was one of a kind opportunity for that specific business. And it repeats now and then in different forms all around. Just as a big picture, the way I would present it is that I see myself as a value buyer in the sense that
yeah,
I want to get a discount up front, not because, mostly because I don't want to overpay. Just in case I'm wrong, just in case I'm too optimistic about the growth potential, I
yeah.
don't want to overpay up front. That's pretty important for me. And
That makes a lot of
then
sense. And sorry to interrupt,
tell
but
me.
so one of the concepts I like is, or that I often see, one of the arguments I see in favor of buying, paying up for great businesses is the idea of justified PE ratios, which in principle I agree with the idea. The exercise where you go back and you say you could have paid
Hmm.
50, 60, 70, 80 times for the following companies back, for the following businesses back in, the 70s and 80s and 90s, and you would still have beaten the market. But I think it sort of relates to what you just said, that of course, before the event, you cannot know that these businesses will carry on growing their underlying earnings at 15% per year for 2 or 3 or 4 decades. And so I also
Hmm.
think it's prudent to, before the event, you don't want to be paying a multiple that assumes that everything will go to plan, right? So I agree. I think there needs to be some sort of valuation discipline or
Hmm.
valuation sensitivity.
And it's very personal and it evolves. It's case by case, right? In the portfolio, you can have companies that you have very different expectations towards, right? You'll have companies that will grow in low single digits, and you'll have companies that hopefully can maintain a low teens growth rate for a long period of time, right? So you have to go in
Yeah,
with the right assumptions for the right company. But the other
absolutely.
side of it, once you buy, because I think a lot of conversation ends with, okay, I bought it, and what's next? And I think the challenge really begins because you have to hold on to it. And there's so many studies, from the coffee can portfolio study to Chris Mayer and Tom Phelps talking about the 100x companies. But then my mindset shifts to what I would call a growth holder. I realized that the company might have closed the gap between what I think was the intrinsic value and what the price was at the time.
Yeah,
But then the stage where quality kicks in and you realize they have opportunities to grow, they have opportunities to reinvest the capital at still very respectable rates. And that second stage is where the real money is made. But it's very tricky because you will get tested again and again and again. This
yeah,
stock will sell off again. And Buffett said, I think Charlie repeated that Berkshire sold off 50% 3 times in the last, or 4 times in the last 5, 6 decades.
I remember
And they
that. Yeah,
basically say if you're not willing to live through that, you probably shouldn't be an investor in this business. But
I
that's the
agree.
reality. That's when you read Chris Mayer, and he was on the show, and or Tom Phelps, the older book that came out a while ago. When you look at the journey from the 1 to 100x, it's not a comfortable journey.
No,
It's a bumpy ride.
but I mean, that's one of the great challenges of investing, isn't it? Because you want to hold on to what you think are great businesses, but of course that's the big and very difficult question to establish whether they actually are great businesses. Because in some cases, you may be tempted to hold on to something that isn't such a great business where there has been structural change, and that's probably one of the most difficult aspects or sort of problems in investing I find to assess.
Mm-hmm.
You know, is this, you have a profit warning or you have some sort of issue, and I have two or three or four holdings in my portfolio that over the last 12 to 18 months, say, have sold off anywhere between 30 and 60% or something, that which is an awful lot. They're big movements for the kind of businesses that I tend to look at, and either
Mm-hmm.
that's a great opportunity, or they're in sort of structural decline, and
Mm-hmm.
it's such a difficult question to answer. And I know I asked Tom Gaynor about this once. I said, how do you sort of make that call? And he said, or how do you know? I think I asked him, and he said, you can't know. You just, you work as hard as you can at trying to figure out the answer, and you take a view, and then, but there are no guarantees. And that's one of the exciting, but also very frustrating aspects of investing, isn't it? That you
It's
may be
it's
onto
also
something, but you may also look like a fool in 12 months' time.
it's all subject to change. It's
Yeah,
all a constant change. When you think about it, the concepts we're discussing today, so quality, and I really like the word quality. I think Steve Jobs had this line that quality is something that other people see, but you can't really market it. And he was talking about
yeah,
Japanese brands, how we say their quality, but it's not really how they market themselves. We appreciate the quality through the use and the experience with the brand. We were packing the other day, my wife and I, for a trip, and we're going through things, and I realized the items, even like the daily items that I have, the sunglasses, the pair of shoes, and so the jacket. There are certain brands that survived all the trips,
yeah,
all the
yeah,
adventures, and they're still in really good shape. And I even have one pair of office shoes that I've had for 12 years. All the other pairs somehow, they didn't last. So quality is something that you see over time and you
yeah,
grow to appreciate it. And it's the same with businesses. You realize, wow, they are repeatedly doing something right. And
yeah,
somehow everybody else has not tweaked their model to do what they're doing. And sometimes the secret, like the actual business model, is very nuanced. What is it that they do? And what is it that they sell? You say, this company sells coffee in a cup with a lot of sugar and caramel. No, they're selling a certain experience, a brief moment of happiness in the middle of the day for somebody who is running between meetings. Right? You have to really understand what kind of a relationship they created with the customer that allows them to have the pricing and the margins and so on. It's really fascinating to
yeah.
be the detective there and see why it
I agree.
works.
And actually, I often think that they're almost more valuable aspects of a business if it's not easy to determine exactly what they are or how you could replicate it, right? So,
Mm-hmm.
because I think often, if you're an analyst for a fund and you're pitching an idea, and you tell one of the PMs that this is a great business, and then you're expected to sort of come up with bullet points of why that is. But I think in a way, if it's easy to sort of lay out the argument or lay out the reasons why it's a great business, it may not be such a great investment. Whereas I think the longer you do it, the more you can rely on the notion that it's an incredible business, but I can't exactly put my finger on why. And of course,
Mm-hmm.
if you're a junior, if you're somewhat junior, you can't, that cannot be your argument. But I think if you're, with experience, and also I think if you're in the right kind of environment where you're investing your own money, or you're investing family money, and you're able to take that long-term view, and you're not having to justify all these things to someone else,
Mm-hmm.
sometimes I will buy into a business which I think is a great business, but I struggle to fully sort of articulate why it's so great. If
It,
that makes sense. I know it sounds
it,
very vague, but in some ways I like I like that vagueness.
I mean, obviously there are metrics, there are numbers you can look at, right? You can look at the
Yeah,
I'm actually talking to somebody next week, and we're going to go over financial statements, and I'll share with him, how I read them. He's a student, and he was very curious. And sometimes I sit down with people, and I show them little things that, I don't know if they're tricks, just a way of doing things. And I told him, if you take the labels off the statements, you don't tell me which company it is, you don't tell me which industry it is, but you give me enough years of history, I
Yeah,
can tell you a lot about that business,
yeah,
right? And I can even tell you if they're pretty honest about reporting what they do. If there's a lot
yeah,
of one-off items, I don't even know the labels these days, but it's earnings before restructuring, and I have no idea, but they have names for those things that you exclude all those things, and suddenly your margins are incredible if you exclude the restructuring, the one-offs, the single-time items, all those things, and then so you can tell how they're communicating with you. Christian, I'm going to pause because I lost the visual on you.
okay.
Are you with me?
It's a little bit, at times it's a little bit blurred, but have you,
But I
you
think
haven't
it's
had issues
recording.
until now, you've been okay? As in the
Yes.
video's been okay? Okay.
Yes. I just lost you this second. Can you see me?
Yeah, I can see you. So I've been able to see you the whole way. It's just that it's been a little bit sort of blurred at times.
So the blur is fine because it records locally and uploads, so that's fine. It's just for some
Okay.
reason I lost your.
Is it better? Is it back
I
now?
can't. No, I can't see you,
Oh, really?
which
Oh. So
makes me
I
wonder.
seem to, and actually when I look at my connection here, it seems to be fine. I'm sure the issue is here
Oh,
because
you're
I've
back.
had.
You're back on.
Am I back? Okay,
You're
cool.
back on. Yeah.
Sorry about
I'm
that.
gonna
Yeah, so
mark
when
this.
it sort of suggests that I should have a good connection, but
No, you're back on. Maybe something was buffering for a second. We'll pick it up.
it could be the builders who unplugged my router. That would not surprise me. They do all kinds of things without asking for permission. So
But you're back on. I'm gonna mark it and take it out. This
yeah,
pause. We were talking about quality. Let's jump forward a little bit since you mentioned it. Christian, I want to ask you about the experience of managing your own money, managing your family money, and at some point you manage other people's money too. And I had a fascinating conversation with a few guests, but I remember Guy Spear talking about his experience. And tell me about the emotional journey of managing family money after managing your own money. Something happens there that's worth talking about.
yeah, they're quite different. I think between managing your own money or between managing family money and your own money, I think there are some differences. But I think
Mm-hmm.
the real difference, of course, is between managing other people's money, as in external investors outside the family. Yeah, I think there's a real difference there in terms of time horizon, in terms of willingness to accept volatility. Well, when we look at mark to market volatility, I think the whole mindset changes. I mean, these days I'm so much more focused on the truly long term,
Mm-hmm.
right? So the idea is that, I'm trying to, number one, preserve or maintain the capital I have. And number two, of course, I want to grow it in real terms.
Mm-hmm.
But my time horizon is, I want to pass this on to the next generation. And so, whether that's 30 or 40 years ahead, but we're talking decades here, right? Whereas, of
Mm-hmm.
course, where you're in an institutional environment, you're looking at much shorter time frames. And of course, that shapes the way you invest. So in terms of concentration, in terms of the kinds of businesses you're invested in, and then beyond that, I think it's also a lifestyle thing. I feel that, managing your own or family money it's a very, you can have long life expectancy as an investor doing that, because you're less likely to fatigue, I find,
Mm-hmm.
because you can have a setup where, whether it's the freedom or flexibility to sort of control your own diary, but I just think you're less likely to sort of burn out early on in your
Mm-hmm.
career. But of course, there are exceptions to that. There are some open-ended funds who have incredible track records, right? And who are quality focused and who are concentrated. And, I think, I'm sure we can both think of a number of examples, both in the US, not least, or probably especially in the US, to some
Hmm.
extent in the UK. I see less of it in continental Europe, but there are some. So I think you can do that, but you probably need to have either a very long track record from somewhere else, or you need to have a very strong name or brand, or I guess you need to have a structure where you can, you know, limit people's ability to redeem their money. So I don't want to overdo the importance of structure, because I think if I go back 10 years, I probably felt that permanent capital was the only way to do it. I think increasingly I see people who found other setups or solutions to this problem. So I don't think it's the only thing that matters, but I think it's a huge, for most of it is for most of us, I think it's a big advantage to be investing either your own money or family money.
Hmm.
And then beyond that, I guess I just prefer the sort of the lifestyle and the control and the flexibility and the joy of trying to sort of build and develop something over time for the future, for the next generation. I just find there's a whole different sense of purpose to it, that in addition to being a good investment setup, it just makes me enjoy doing this every day.
It's the idea of planting trees for others to enjoy
Absolutely.
and sit under.
Absolutely. And
And
partly
it's
for us to enjoy, right? We
no,
enjoy the planting, right? We may not
very
be able
much
to
so.
enjoy the trees fully, but we can enjoy the planting.
I like to look at it as when you expand your investment horizon, you elevate the quality of the work, and the benefits will happen, obviously, in 100 years, but they will start to happen sooner. And
Yeah.
I think that's what gets lost. And it's the same with when I talk with Chris Mayer about the 100x stocks. It's not that every single idea has to be 100x, but it also means that you just increased the power of your no filter
Yeah.
that will allow you to say no to a lot of different ideas that will waste your time, maybe even waste your money, take away your
Yeah.
attention, and you focus on the ones that really have the potential. And I
Yeah.
like this idea of what kind of a stock deserves to be held for 20 years. And I frame it
Yeah.
this way. I wrote an article, A Stock for a Grandchild. A year ago, a client asked me about one stock that I would recommend for a grandchild. And I took that idea pretty far and I thought about it a lot. And I've been thinking about it since, because it's not a stock that I know will be around in 20 years because they're doing something mundane and it's very predictable. I get that. That's nice to have as well. I think it's an anchor in a portfolio, especially if you're managing all of somebody's money.
Yeah.
But then there's a certain sub segment of the portfolio that will make the biggest difference. That's the one, the coffee can part, where you have a handful of stocks that make the biggest contribution. And these are the stocks that I call them, they deserve a 20-year wait. So they will do something repeatedly for 20 years that will make them a bigger, better business, right? It really filters out so much of the market. And let's put the price aside for a second, but just the kind of business that it is, that will have opportunities to reinvest at high rates, will have ways to grow, and we'll have a long-term vision about the growth. We'll ignore the quarterly earnings. I mean, the list gets shorter and shorter and shorter. And usually you realize that either there's a family behind this business or there are original founders behind the business, but there's
Yeah.
some sense of like a center of gravity that's taking this business to a bigger, better shape and form down the road. And it deserves to be held. And you touched on something that I really like, which is the other side of what we do. Whose money are you managing? Which is something that
Yeah.
gets lost somehow, somewhere, I think, in the
Yeah.
most institutional part of the business, where somebody's running a fund that has 1 million investors, each put in $1,000, and you have no idea if they're young, if they're old,
Yeah. Of
what's their
course.
story. I like the aspect of giving money meaning. What does this money really mean to you? And I have the privilege of working closely with the people that I know, the individuals and families that I work with. And then I'm very close with the investments. I know what the investments are, but I really like the human aspect of it, that I know what that money means.
Yeah.
And you have to, the two sides have to coexist, your investment style, the holdings that you have, and the people that you're really serving. And if there's a disconnect, this will create a problem at some point.
I think when absolutely, I agree with all of that. When I worked in the institutional world, of course, you're managing, you're managing these investments for people whom, in most cases, certainly when you're managing retail money, whom you've never met. You've no idea what their sort of ambitions and their risk tolerance and their sort of passions and values are, right? So you're managing a product. You're not managing, it really becomes a case of product management. And
Mm-hmm.
there's, I guess that sort of serves a purpose, but for me, that's not what that wouldn't be enough to sort of keep me going for the long term. I think I want something else to be working towards,
Mm-hmm.
say handing over a business to the next generation in better shape, or with more value than when I came into the picture. So I just think that's such a great motivation, and it's also a great risk management tool. So I agree with you. I much rather work in an environment where I know what the sort of objectives and values and risk tolerance and all these things are. I think it makes it easier and more meaningful what we do.
I like to call it infinite investing, as in investing with an infinite investment horizon. When you really think about it, when you're managing money for yourself for the lifetime and then beyond for the next generation, it is an
Yeah,
infinite investment horizon. And when you really pause and think about it, and I can't help but think about the infinite game, finite game, that James Carr's book that he wrote a while ago. When you realize that most of the games we play in our lives, all the way since we were kids, you mentioned how your
yeah,
parents with your sister were trying to create a bit of a competition with the two of you. I think that happens quite a bit with kids. Any game they play, they want to know, did I win? Did I lose? Right? Any game we
yeah,
play, did I win? Did I win? And you
yeah,
realize most of the games that are worth playing are games that are more about building rather than winning or
yeah,
losing. And it's
yeah,
once that clicks, you see the world in a completely different way. And I like to compare it to friendship. Friendship is not a game that I can win or I can lose. What I want out of friendship is that I want it to last and I want it to
yeah,
get better. And it's the
yeah,
same with many relationships that we have, right? Friendship, marriage, client relationship. We briefly talked about before we hit record about the salesman driven culture of the investment world, the finance world, right? It's all about I have to hit a certain quota by the end of the month. I have to sell this product. If I hit the quota, I'll get the bonus. It's the carrot and the stick, carrot and the stick. But if you build a client relationship side, you talked about the permanent capital, and you have a handful of clients that are in it with you for the long run,
yeah,
it's a game that you want to continue. And the capital on the other side, you want that capital to grow. And the last thing you want is to have any single event that could totally wipe out the capital. And
of
we've seen
course.
so many hugely successful money managers out there with billions of dollars that took risks that were just not worth taking. And there was somebody whose name escapes me that a few years ago took this elaborate bet and with the participation of some big banks and wiped it all out
Yeah,
in a matter of,
but
days. Go ahead.
I I agree with the notion that it's about sort of staying in the game and all these things. I should say, of course, it's not that I don't care about the returns and the sort of rate of growth of my capital, because I also ultimately, I want to perform in the sense that, I want my returns to be strong, right? I may not look at whether I'm top decile or quartile or bottom decile or quartile over a year, but I try to be
Mm-hmm.
as sort of aware of what's going on in markets and what peers are doing, and am I adding value? And of course, the number one priority is to stay in the game,
Mm-hmm.
because ultimately it's my capital, and it's my livelihood and all these things. But of course, there is also an element of ultimately the numbers sort of really matter, right? So it's not altruism in the sense that I don't care about returns, but I think it's just a different time horizon, and it's a different, and there's so much more emphasis on wealth preservation
Hmm.
primarily, but I'm certainly trying to find a balance between that on the one hand and growing my capital on the other hand. So both matter, but I think the emphasis is different compared to institutional money management, where the only thing that seems to matter often is, generating the highest possible return in the next 12 or 24 months, or even shorter than that. But of course, there's exceptions in the institutional world as well. So I don't want to generalize too much, but I agree with you. I think having managing your own or family money, I think changes the rules of the game.
I like this thought experiment. So let me ask you, and I'd like the audience to think about it too. For a second, imagine that benchmark and indices, indexes were never invented. And Dow and Jones, I don't know, they decided to go the other way, started writing
Yeah.
about nature. And they were never invented. Nobody ever came up with it. We don't have an index. You would still invest. Let's say we have the same businesses, everything else is the same. How would you invest?
I think I'd invest the way I do now.
Hmm.
I can't see that it would change things very much. I try to be aware of the benchmark, and the first job I had in the industry, the guy I worked for at the time said, we're not, and I'm sure many people in the industry say this, we're not benchmark driven, but we try to be benchmark aware. And I think that made a lot of sense to me already back then, as in, it's good to be aware of, effectively, the opportunity cost or the hurdle rate, right? What is the
Hmm.
market as a whole doing? I think that's
Hmm.
important. I think it's important to have some awareness of what you don't own. So, for instance, I've had very little exposure to what we call technology, and especially US technology. And it's important to be aware of these things, right? Because if you go through
Hmm.
a period of underperformance like I've done for a while now, I
Hmm.
think it's very important to understand why that may be happening, so that you don't rush into decisions that are sort of detrimental to your long-term wealth, right? And so I think it's really important to be aware. But would I invest any differently? I don't think so. I do think it's a very high hurdle. By the way, the index. I always felt that, in a way, the index is, reflects creative destruction, right? The
Hmm.
all the sort of forces of a market economy,
Hmm.
and if and effectively you're getting, through the index, you're getting more exposure to companies that are thriving and doing well, and you're getting less exposure over time to companies that are, in decline or disappearing. So it's a very high hurdle. You're effectively, as an active manager, you're saying I can do better than the market economy, and that is a very big claim. So I think it's good to be aware of. I think it's a pretty tough sort of yardstick to measure yourself
Hmm.
against. But I don't think I'd invest very differently from what I do. I think it is difficult to find the right benchmark. So for me, for instance, historically, I've looked at European companies, and I think about three-quarters of my portfolio is in Europe, and the remainder in the US. But should I be looking at a global benchmark? In principle, I guess you could argue I can invest in anything, and
Hmm.
in some ways it shouldn't even just be listed assets, right? In principle, I
Hmm.
could invest in anything I like. Should I just be looking at European equities? In some ways, it doesn't matter because I don't manage institutional money now. But in some ways, it's a very important question, right? What is my real hurdle rate? I don't have a good answer to that, other than trying to look at a few different measures. So I look at the global benchmark, I look at Europe, I look at what growth has been doing, what has value been doing, and I just try to, I guess, provide a bit of context to myself to understand why I may be outperforming or underperforming. And I'll be perfectly honest, when you go through a period of weak absolute and relative performance, as I have done lately, it's painful. Even if you don't have external investors, I find it
Hmm.
painful. And and on one level somewhat stressful, even if ultimately I just answer to myself, because it sometimes makes you feel like a failure, even if you're not accountable to other people. And I think in some ways that's probably healthy to have that discipline that the benchmark brings. So
Hmm.
I certainly keep an eye on it, Bogomil, but I try not to be too influenced by it. But it's difficult.
It's a very emotional journey, an investor journey.
For sure.
Obviously it's intellectual and it's rewarding in many different ways, but it's a very emotional game, especially if you want to do it over a longer period of time. To me, if there was no benchmark, it would have no bearing, just as you said, on what I'm trying to do. I am aware that benchmarks have been invented and they exist. I'm also aware that they're man-made. I'm also aware of what you touched on, that they continuously change.
Yeah.
Even they're not composition in the sense alone of the stocks that are in it, but how much certain stocks represent of a particular benchmark.
Yeah.
They are driven by momentum. More of the fastest rising stocks, that's how they're built, especially the ones that are driven by market cap. So that's something you have to take into account. It's almost as if we're all racing to a cliff, and just because somebody's running faster, maybe it's not the right guidance. I'm always curious, why is the benchmark up? And not to me, it's not enough to say, oh, it's because of tech or it's because of, it never happens, but let's say because of utilities.
Yeah.
But I want to understand, was it driven by earnings going up? And
Yeah.
I have a second question. Are the earnings up because of some temporary shift in demand that's not sustainable? Is this a temporary shift in pricing? I want to see if it's a permanent change in the earning power of a particular part of the universe.
Yeah.
Then I start to pay attention, because I'm at the end of the day, what I'm trying to do, and I think what you're trying to do, is buy streams of cash flow, and not
Yeah.
today's cash flow. It's future cash flow. So it's cash flow that you and I have no guarantee what it will look like, but we're trying to make the most educated, I don't want to say guess, but assumption about how it could look like in the future, right? And I think we both want to be the least wrong about it. And then we realize at any given point in time in history, different segments of the universe collect more and more, bigger and bigger pools of earnings. And that's what I start to pay attention to. Like, something is shifting, that these
Yeah.
kinds of companies are collecting more and more of earnings. And sometimes the scale is staggering. Like, you have
Yeah.
one or two companies that are collecting as many billions with a B in earnings as the next 100 companies, right? So that's
Yeah.
something that I start to pay attention. But at the end of the
And over,
day, go ahead.
I should say, over longer time frames, I think it is relevant for most of us to look at or be aware of what the benchmark is doing. Because if over a 5 or a 7 or a 10-year period, I'm not, keeping up with, you know, broad measures of market performance, at least I
Mm-hmm.
want to understand. And in some case, and in some cases, it may mean that I would have been better off just putting this money into an index fund, and that's an option that is available to me. So
Mm-hmm.
I think to me it feels like a relevant, meaningful thing to be doing. But I agree with you. You want to understand why the index and the internals of the index is behaving in a certain way.
Mm-hmm.
So sure, you want to dig deeper than just look at the sort of headline numbers and um,
And
and let that sort of guide your behavior.
I think there is room and time and opportunity to consider an index fund. And I think for some investors, and Buffett said it too, and many other people mention it as well, how there are times and circumstances when an index fund is a valid option. I like to look at it from my professional experience, which is, I see really in very general terms two types of investors. One I see is somebody that has a lifetime of contributions, and the other one that has a lifetime of distributions. And it varies through their lifetime. But just to make it super simple, the first one makes a contribution of $100 or $1,000 or $10 every now and then, right? and can spread out investments over a lifetime. This is like the traditional, even retirement thinking, planning. So you don't really have to have any understanding if the market is high or low, overpriced or undervalued. You're committing $100 from your paycheck every now and then, and it's automated. I think there's beauty in that format because it kind of minimizes some mistakes and takes a lot of the emotional side of it if you stick with it. I think it's very, very hard. And the
Yeah.
second one I call a lifetime of distributions, where that's how a lot of my clients look at it and that's what they face. It's some sort of a liquidity event. And it could be an inheritance that comes, or it could be a sale of a business, or it could be a pay package from a company, whatever it is. For one reason or the other, they're facing a substantial amount of money that comes to them. First of all, it's a realization that it might happen only once in their lifetime, which I think
Yeah.
helps quite a bit to set certain rules for what you're going to do about it. And second is to lock it in and put it in an index fund on a given day and forget about it. You give up so much flexibility and you make so many assumptions about where the market is. It's a very different proposition. It's a very different set of risk rewards and so on to consider when you have a once in a lifetime kind of event. Locking it in an index fund, I don't see people do that. It's a very different moment. So it all depends on the context. That's why as we said, investing is very nuanced. Tony Deaton had this story how they asked him to give one stock recommendation to the audience, and he says it's like asking a doctor for what's the best medication these days.
Yeah.
Well, I don't know your situation. You have
I
headaches,
agree.
you have a back pain, you have a
Yeah.
knee pain, you have issues with your stomach. Like what do you need? I can't give you one single medication, a miracle
Yeah.
drug. I mean, I'm sure there are people who do that. I think about it.
By the way, I agree. That's why I find it increasingly difficult to, when you're asked to pitch an idea,
Mm-hmm.
I still think that's sometimes it's fun, sometimes it's quite sort of useful to test your ideas with other people or in a group of smart people. But I find, if you're presenting at a conference or
Mm-hmm.
increasingly, I find it's very difficult to present or pitch ideas to a general or a broad audience because, they would need to understand what my circumstances and goals and structure and not just on the asset side, but the liability side. What am I, funding with this portfolio? What kind of distributions am I looking at?
Mm-hmm.
And so I agree with you. I think it's very hard to, when you don't know the specifics of the situation. I also think the benchmark is, in some ways, it's a peculiar concept because in any other industry, I don't think you compare everyone to the average of the industry. So
Mm-hmm.
you can still, as an investor, you can still see capital growth. You can still, increase the value of your portfolio, even if
Mm-hmm.
you're not growing it in line with the index, right, or the general market. And so, in absolute terms, you're still growing your wealth. Now, from an institutional point of view, I can see why everyone is compared to some sort of benchmark, and there's all these league tables, but that's a slightly different game, isn't it? The idea that all of us are trying to sort of figure out whether we're better than the average of all of us just seems. I think if you're investing your own money, I agree. I think it's less meaningful.
I think it's only relevant when you make that choice. I'll spend a lifetime of contributions and
Yeah,
I have a choice of committing some time to it or hiring somebody to help me, or I
yeah,
will just automate it and let it be, which I think it's a decent option. I think worth considering. I don't know everybody's circumstances listening to this podcast, so talk to your advisor about it, but I think it's something worth considering in a particular context. But I think you touched on something even bigger here. When you look at the portfolio, you and I could sit down and by the end of this conversation, build a portfolio together of, I don't know, 10, 20, 30 stocks, whatever you want, whatever people would ask for. But at the end of the day, it's a journey. This portfolio will change and evolve. And And Joel Greenblatt had this thought that I really stuck with me. He had this simple formula of investing in basically quality companies at a low price, and it's well publicized. But he said how the volatility of that portfolio was a real test to his stomach. And when I think about it, when you look at the returns, or even what do you think the risks are of permanent loss of capital, the journey to get there might not be something that a lot of people can tolerate.
Yeah.
And it's fascinating when I onboard new clients, I like to see us go through a bear market and a bull market together. I think that's, we can have many conversations before, but I think for the two of us to go through it together, it's an eye-opening experience for both of us. I think we're going to both learn a lot about each other. And in that moment, I really see, how we both react, how we talk about the drawdowns, what it's like. I took calls in March of 2020 that I will remember for the rest of my life. They were really, big emotional conversations, and clients would tell me sometimes, I just wanted to hear your voice. I know you're buying, keep buying. I just wanted to hear your voice. Buy. And it's that feeling that somebody's at the helm taking care of things, and you earn people's trust in those moments. So a beautiful portfolio that has the best metrics and beats the benchmark, back tested and so on, might not be the portfolio that anybody could actually hold on to through a
No,
real
I
storm.
agree.
I think that's something.
I I agree with all of that, and there are some successful examples of, you know, institutional managers who I think have sort of adopted those principles. I think of someone like, I think Troy Asset Management in the UK and a few others, which I think they explicitly sort of work with that notion that, my investors may not be able to bear the ups and downs of the market. So this is the best thing for them is to have, in some cases, they have fixed income in the portfolio, or they have companies with certain characteristics. I think in a way it's easier for me, for instance, because I'm comfortable, because in this case, I'm the only investor, and I'm comfortable with the mark-to-market volatility, and I invest the money myself. So I have full transparency. And then I also have the freedom to say I'd rather do things my way and make 10% per year than do things some other way and make 12%. And actually look, I'd rather make 20% per year if I could reliably over a very long period of time. I don't think I can. And of course there's a trade-off when that, if you were talking about 20% compared to 10%, that's a real meaningful difference. But would I give up 1 or 2% per year to do what I do now, compared to buying sort of deep value or something, absolutely. So I'm not certainly not claiming that this is the only or the best way to do it, but I'm happy to pay, even if I knew I was paying or giving up some return, I'd carry on doing it because I enjoy it.
It works for you, and you're honest with
It works
yourself
for me
about it.
so far. Yeah.
I want to ask you about the soul in the game. I think we both like that concept. Nassim Taleb talks about it, and the reason why it resonates with me is that what we really want to buy in terms of a business and the management and the talent, it's sometimes something that's not really for sale. And let me explain. You want to find a manager that will run the business way beyond any monetary incentive.
Yeah.
Because sometimes, I buy into businesses where the founder is worth a few $1 billion, and I know it's not a monetary incentive. So it's fascinating how much time we spend on incentives, and we think we can tweak them and tie them to various metrics. But then we realize that the best of the best are the ones that have some sort of a true calling, a passion to make this a bigger, better, longer lasting business. And you can't see it in the numbers. I mean, it's not that visible. I mean, maybe you can get a hint of what somebody's actually doing here, but you get a feel for who is actually running the business. Can you talk about it? Because I think speaking of quality, you focus on quite a bit of who is at the helm.
Yeah, I think it comes back to something we talked about earlier, this idea of doing the right thing, even if no one's watching, and doing things for non-financial reasons. Now, I guess often there is a lot of overlap here, because if you have a successful founder manager, or if you have a successful multi-generational family business, they will also have a lot of financial exposure, and they will probably have, and in many cases, or in most cases, the people we are referring to here are probably wealthy beyond imagination, right?
Mm-hmm.
But I think the point is that even if they weren't, they would
Mm-hmm.
carry on doing what they're doing, because of I guess pride in what they do. And it's one of these things. It's a bit like, in some cases, when you try and describe a quality business, it's very hard to put your finger on it.
Mm-hmm.
You just need to be there to experience a few of these, or see a few of these examples, right? But I guess it's doing the right thing. So, and often that's reflected in having a longer term time horizon, right? Being
Mm-hmm.
willing to invest up front, being prudent in terms of how you manage the balance sheet of a business, being focused on your customers and your staff and the product, as opposed to the sort of short to medium term financial delivery. There's some of the things you can look for, but I think ultimately, when you're around one of these people, you just know. And I
You
think it's
just know.
so powerful because it's so durable. So financial incentives are important, I think, in some situations, and they can work, but they're only as good as the way they're designed. Whereas
Mm-hmm.
I find with soul in the game, or pride in what you do, or whatever name you want to give it, it's one of these timeless things. Well, it's timeless up to a certain to a certain extent, right? When you have a succession, or when someone else takes over the business,
Mm-hmm.
of course, that's the real test. And I have one or two examples in my portfolio where I feel that will probably, I can't know for sure, but I think that will probably work out pretty well. And I have one
Mm-hmm.
or two examples where I'm somewhat and increasingly concerned about how well that soul in the game will be preserved. So um, yeah, I it's super important for someone who's looking for long term,
Mm-hmm.
sort of to be a long term investor in great businesses. And the only way I think you can work out if you're onto something is by spending a lot of time trying to sort of understand the business and the people who run it, and their mindset, and the culture of the place. And then I guess at some point you need to figure out, do I think that has been institutionalized to some extent, so that the next generation of owners and managers of the business will sort of sustain that.
Has it become a part of the culture? I think that's what you're touching on. And it's also
Yeah.
across the whole company. Can you tell that everybody involved has pride and soul in the game? And yeah, they remember about the bonus and the incentives, but they really enjoy what they do. They enjoy the clients, the experience, and everything about it. And it's hard to find, and it's hard to replicate. And you mentioned, I think it's hard to maintain over a long period of time as well. But
And
it's
also,
fast. Mm-hmm.
I should also say, Ogumil, I think if you look at the larger the organization,
Mm-hmm.
of course, the more difficult, and the more complexity there is, the more difficult it is to sustain that. I appreciate, so, we have holdings in some companies where I am fully aware that most people or many or most people in the organization don't get up in the morning thinking about things like soul in the game and doing the
Mm-hmm.
right thing. And right, you look at companies like a Nestle or Diageo or any of these large corporates. Of course, most people, for most people there, it's a job. But I guess, and in some cases, that's perfectly fine, because the quality of the business, or the sort of characteristics of the industry, are such that you can probably get away with that. And top management seem to have the right kind of priorities and mindset, and so it's not a black or white. I think when you find people with soul in the game in a great industry or a great business, you can
Mm-hmm.
get tremendous outcomes. I don't necessarily think that all of everything we're invested in, every single company in our portfolio, would sort of pass the test of the management team having, the same level of commitment or soul in the game or pride in what they do as some other businesses we're invested in. So, as always in investing, there are these trade-offs, right? And I
Hmm.
think the larger the organization, the more difficult it is to insist that everyone, subscribes to that view, as opposed to the place you go and get your coffee in the morning, or the bakery you go to, or right, there you probably have, it's much easier to sustain that kind of mindset.
Hmm. It's hard to find, but when it happens, it's pretty unique and it's worth paying
Yeah,
attention, especially, and you highlighted it, if it's a great business and a management that has the quality we're talking about. I think some incredible things can happen over a few decades. So
indeed.
that's something that I pay attention to. I have another thought experiment for you. Speaking of managing family fortunes, I think there's this moment where some families might be overwhelmed with the choice, the asset classes, the flavors, the strategies, and different markets. And there's no shortage of salespeople that will pitch anything you can think of, repackaged
Mm.
in various ways. And that adds complexity, it adds fees. And it also adds, I think, a danger of some unforeseen risks, because if the more complicated whatever it is you invest in, the less you can actually figure out what is it that I hold. For a second, imagine that to you, yourself, your family, the only asset class that's available is publicly traded equities. Would you be able to accomplish what you're trying to accomplish?
So I do apologize, Bogman. I lost you for about 10 seconds there.
Okay.
We got to the point where you said, "Imagine."
Oh, all right. I'll mark this.
Do you mind just retaking that? Because I think I know what you were you were going to say, but it'll probably come out better if we redo it. Now I think you're muted. Actually,
Can you
yeah,
hear me
there we
now?
are. Yeah, now I can hear
Okay.
you.
Okay, let's take it from there. All those products add complexity, fees, and I think a danger of some unforeseen risks that might be hiding in all of it. And I'm curious if you would entertain me and consider a situation where you could only invest in publicly traded stocks, securities,
Yeah,
and would you be able to accomplish the goals that you set out for yourself?
I think for me the answer is absolutely yes, and I think it goes back to the kind of what target returns do you have? If you have target returns, what kind of risk appetite do you have? What's your circle of competence, right? So I've always worked in public equities, so I've certainly considered the idea of investing in private businesses, and maybe at some point that will happen. But so far, I've always felt, I've spent say 20 years investing in listed companies. That's probably where I should be spending most of my time, and where I should be allocating most of my capital,
Mm-hmm.
and the kind of return targets or hurdle rates that I'm looking at, I think are consistent with owning great businesses in public markets. So I think for those reasons, I think I can, I'm comfortable investing in listed equities, as opposed to what you're describing, where we may have a bucket for fixed income and we might have commodities and real estate and what have you. So they're probably some of the things that, or some of the reasons why I'm quite happy just being invested in listed equities, for now at least. And then there's also the fact that my view at least is that if you're very large, you may have some advantages in private markets in terms of deal flow, and you get a look at the great businesses early on and all these things. And of course, it's very research and sort of due diligence intense.
Mm-hmm.
Whereas in public markets, I often think being small to medium in size may
Mm-hmm.
bring certain advantages, not just in terms of price impact, but for a number of reasons, liquidity and all these things. So I sort of feel like, it also plays to our advantages being
Mm-hmm.
focused on public markets for now. But of course, with any of these things, you have to be pragmatic, I guess, and flexible. And I see no reason to change it at this point, at least.
No, it makes sense to me. I think you mentioned the circle of competence. I think some families gravitate to real estate investments in the first stage. So there was an initial business that I've seen, and they create wealth in that initial business, and somehow real estate becomes a part of it. Maybe the business held some real estate, or it's somehow there's some connection. So they have some expertise, and they naturally flow to that part of the world or asset class. And then
Yeah.
eventually they start to embrace the public markets. With businesses, we talked about buying businesses as a stream of cash flow. But so you would think private public, why would it matter? Isn't it the same? And in many
Yeah.
ways it is the same, but I think that the nature of the sale or the nature of the purchase, it's different. And let me explain how I look at it, and I'm curious how you think about it. If you know somebody with an incredible private business,
Mm.
and that business doesn't need outside funding, and he has his kids involved and maybe even a hired manager that he likes, and you knock on their door and you say, I want to buy 20% of your company, they'll say no. I mean, I don't need an outside investor. And if they do
Yeah.
say yes, will I be treated the same way as your daughter and your son and your cousin? That's part of the
Mm.
company, right? It's natural. That's an obvious question. I've seen it happen. So the public market allows you to be a minority shareholder in a collection of businesses, and if you do your work, you'll be treated properly by the right managements, just as the majority shareholder would be. That's one thing. Second thing, in the private market, if somebody has an incentive to sell, apart from maybe a transition between generations, very often the sale happens when something unfavorable might be happening that I'm not aware of because I'm not an
Yeah.
insider.
Yeah.
Maybe a new competitor showed up. If it's a gas station, maybe this owner knows that a second gas station is opening up across the street. The revenues you're showing me and the cash flows I'm hoping for, they won't look the way I
Yeah.
think.
Yeah.
Or maybe regulations are changing. 1,000 things can be changing, or your cost structure is changing, or your major input just tripled in price and you can't see it ever going down in price, and half of your margins are going down. So when you have a very motivated, and I emphasize the word motivated, private market seller, the reasons might be
Mm.
hiding behind it, and they might be a permanent change, if not damage to the business. In the public market, which I would like to emphasize, is that you have an anonymous shareholder that
Yeah.
kind of panics together, just like lemmings do, and runs one way or the other. And you talked about the macro at the beginning. And you have an incredible opportunity to buy some really great businesses at a low price, not because something wrong happened with them, but because of the nature of a public market. We
Mm.
all panic together.
I agree. I think irrationality in terms of pricing on the downside is often, or most often, I think much greater in public markets. I do buy the argument that in private markets there are other types of inefficiencies. Businesses are under researched or overlooked for other reasons. The amount of due diligence or the complexity or the lack of liquidity or any of these things. But I often find that the arguments in favor of, say, private businesses or micro cap, or they look great on paper, but I always ask myself, so I'll have people saying, why do you not invest exclusively in, say, micro cap or private businesses? But I always ask myself, where on paper that may make sense, but is that where I can achieve my goals in terms of returns and risk levels? And right, I don't care so
Mm-hmm.
much about the principle or the theory. I care about whether I can, when I implement this, can I sort of, in practice, can I get to where I want to
Mm-hmm.
in, say, large public companies, or does it require getting involved in small private businesses? And so far I feel that I can get to where I want to in
Mm-hmm.
large, medium to large listed companies, and I enjoy operating in that world. So for now I see no reason to change that, but who knows, maybe at some point we'll partly sort of get involved in that world as well.
And I think we all evolve as investors, right? So at this
Mm.
given point in time, you might feel a certain way, and you might open yourself up to smaller companies or even privately held companies. The other point I wanted to mention when I think of private and public, in the public world, you have companies that, not all of them, but some of them, they have kind of an open-ended upside potential. And I look at it and I'm thinking of Peter Lynch and his book One Up on Wall Street, how he would tell those stories of a hotel chain or a restaurant or even, I think there was a hair cutting service that became a chain. He said, it worked in Pennsylvania. It would probably work in California. Eventually, it's in 50 states. And the U.S. has this huge advantage that it's it's one country, very, very different, but one country, one currency, one payment system, and so on and so on. So if something works in one state, you could have it in 50 states. And guess what? Somehow the whole world finds it appealing. It's an American brand. It could be in 150 countries. So there are more of those open-ended opportunities that I see that could really scale 100x in the public markets. And in the private, eventually, if somebody notices that they have that potential, they do become public because they need more
Yeah,
capital. They need, right? So
yeah,
it's interesting how you go through that transition. And if you're looking at the long, long runway that I think both you and I are looking at, I see more of those runways in public equities than I can see in private. There are some exceptions, of course, some companies that really held on to being private for so long, but it's more of an exception.
but I can also, no, absolutely, I agree with that. I can also see that if you have the skill and the network and the sort of deal, access to the kind of deals that I think only few people have, then if you get involved a very early stage in some of these private businesses, and especially in the more sort of venture capital type situations, of course the upside can be tremendous, right?
Mm-hmm.
But for me, I don't. That's not my skill. That's not my. I don't operate in that world. I don't have a network there. I don't
Mm-hmm.
have the right setup for that, and I don't think I need to in order to achieve what I'm trying to do. So
Mm-hmm.
I very much admire and respect people who do that, but for me, I don't need to or want to do that at this point.
It goes back to what we've talked about throughout this conversation, like knowing exactly what you're good at, what you
Mm.
enjoy, and the kind of investments that you feel comfortable holding on to. I think that's a
Yeah,
very honest
absolutely.
conversation to have with yourself. Christian, I could hold you all day, but I want to ask you one last question, and it's a big one. I'm curious about your definition of success. How do you think about it?
That is a big question indeed. Um, yeah, there's so many dimensions to that, but I think it's really changed over time, right? Partly because of age and partly because of, or largely because of family, I think.
Mm-hmm.
So I think that it's so much easier with when you have children, it's so much easier to, I think, to set your priorities in a way that
Mm-hmm.
clearly the priority is family or children and sort of keeping healthy, and then I think after that it's work in a broad sense, and after that it's all the other things, all your hobbies and interests, but I think success for me now is seeing my daughter being happy and healthy and developing. That's the most exciting thing that
Mm-hmm.
that I'm part of, and so that's real success for me now. And you try and support and help and encourage in any way you can, of course, including financially, but mainly in other ways. I think in a sort of business context, I guess success for me is developing the business and sort of hopefully handing that business over, and it relates to family, which is also something I love about having a sort of family business, which is that the two are very sort of closely integrated, right? Family
Mm-hmm.
and business, or family and work. So handing over you developing the business and handing over a more valuable business in 30 or 40 years time. I think that's the ultimate sort of measure of success I would use in a business or professional context. And I guess more generally leaving a legacy in terms of the business and the capital, but also, and more importantly, in terms of values. And that's something I work on, every day. And sometimes you feel you're doing a pretty good job, and sometimes you feel you come up short. But that's part of the fun. Well, it's part of the frustration and the fun. But I don't think there's any surprises there in a way. It's. But it is interesting how these things change and I think change over time. And I think especially in the sort of industry or business we're in, right? When
Mm-hmm.
when I started working for a fund when I was 25 as an analyst, you have very different goals and objectives, and my definition of success would probably have been very different. But I feel what I enjoy about where I am now is that I feel like I can work towards those goals for as long as I'm able to, right? I don't need to worry about setting new goals or ambitions or
Mm-hmm.
objectives. So that has changed, I think. So now it's more a question of executing, which is that, and that's of course that is the big challenge.
I like the sound of that. It made me think, and you touched on it earlier, how in our industry there are people that do very, very well for a decade, and usually it
Mm.
overlaps with some sort of a cycle, and then they step away for various reasons. Usually I think they like the record that they see behind them. I think that they're ready for something different. I don't know, maybe all kinds of reasons. But and then there are other people who do it over a lifetime, like Warren and Charlie. They had no intention of ever stopping, and I think you and I look at it as a lifelong pursuit. And then
Mm.
other questions come up and you talk about structure. I would call it also environment. And that's what I talked about in Zurich at the event where you and I crossed paths this summer,
Yeah.
where I think more later on, and I've been in the business 20 years. I'm 43, so I feel like a kid in some rooms, but I feel old in other rooms, depending on who is in the room.
Indeed. I know what you mean.
but but I start to pay attention more to the environment, and it's not just the place and my schedule, but it's also the people that I spend time with and how it all has an impact. And you and I briefly talked about, in New York, I would get pulled into all those lunches that somebody else paid for, and I was sold on different things. And I think a lot of people in our business are sold on things. The clients I work with, they've been sold on everything imaginable, and until they found somebody they can trust, I think it's a journey.
Yeah.
But you look for an environment that will serve you over decades, not something that could have worked for 3 years. When you're an intern and somewhere over the summer, yes, you can work nights and day for a couple of weeks and then make it up after the summer. But there's some things that are not sustainable, and you used the word sustainable a couple of times. What's the environment that truly serves you and allows you to accomplish those goals? And I think that kind of a journey, that sounds like success to me, figuring out what really works for you. And I love the pursuit here, and I love the intellectual part of it. I find it fascinating, just discovering new businesses, and I feel like it's an open-ended game, if you want to call it a game. There are new businesses that get started and listed every year. For me, it's a never-ending kind of game. That's why I like the word infinite, because when you really think about it, it's the joy of playing the game rather than calling yourself a winner or a loser, and seeing
Yeah.
yourself more as a builder. You talked about legacy, but that's how I look at it too.
I like the sound of that. That makes a lot of sense. And I think if you end up in the right community of investors, it's also such a nice, supportive, positive group of people, whether it's the kind of people that we see in Zurich or in Omaha, or it's just a nice group to be a part of.
Mm-hmm. It's interesting because after a while you start to invite certain people into your circle, and you kind of feel like,
Mm.
is everybody like that? I had a call the other day with somebody, and they said, we talk about those short-term investors, but I haven't talked to one in a while because all my
Mm.
friends are actually very long-term and patient. So there's a moment when you feel like, has the whole world changed into very patient and disciplined investors, or just my
I think
circle of friends?
the answer to that is certainly no. And also, I should say, I don't sort of, I don't necessarily want to, I wouldn't argue that one is better than the other, because there are in some ways, I respect people who come into the industry and, you know, in some cases generate incredible track records for 5 or 10 or 15 years, and they make an awful lot of money and they go off to do something else. And some of them have incredible skill.
Mm-hmm.
But so I think that's perfectly fine, right? If depending on
Of
your
course.
interests and personality and ability, but it's not for me, and it's not for you, and
Hmm.
or I think, but of course, there's also danger. I think in, as with any community, I feel this way sometimes when I'm at the AGM in Omaha, that that it's great to hang out with like-minded people, but you of course have to sort of be mindful that there's
Hmm.
that there is a tendency to reinforce and each other's views and all these things. I think what's good about investing is that the market mechanism is there to sort of
Challenge you.
will exactly. So I think, and it's a business where over time you have to sort of be I think intellectually honest to stay in the game. So I think in a way that sort of takes care of itself over time, at least.
I I had David McRaney on the show. The episode will air by the time this one airs, and
Mm,
he wrote a book, "You're Not So Smart," and the other one, "You Could Be Less Dumb," something along those lines. And the last one is "How to Change Your Mind." And he's fascinated with the idea of how we make up our minds. And I think in the investing world, we make up our minds. It's hard to change our minds, and it's nice to be challenged. Whenever I give talks, I often mention at the beginning, this is my experience so far. That's what I've learned.
mm,
But
yeah,
feel free to poke holes in it and tell me what I missed. And it's usually driven by very personal experience. We don't all see the world the same way. You and I could look at the same set of statements and talk and be in the same meeting with the same CEO, but we're going to experience all of it through a very different set of criteria and values and stories and personal experiences, and we'll walk away thinking, I should buy more of it. And you might walk out of it and say, you know what, I'm selling all I have. And we can still maintain respect for each other, that
yeah.
for some reason you see something else than I do. I think that's the beauty of it. So even if you have the broadly defined, Buffett Munger follower group in the room, we don't own the same stocks and we don't make the same decisions. We even don't have the same structure of portfolios. I know people that own 5 stocks, and I know people that have much bigger portfolios. So it's all an expression, a very personal expression of who you are and how you see yourself as an investor.
No, I agree with what you said there. I also always try to emphasize that, if I speak, especially if I speak to students or people who are early on in their careers, that this is certainly not the only or even the best way of doing things, but it's my way of, it's something that works for me. Just see it as one of many sort of possible ways of navigating this fascinating game, or this fascinating world of investing. So I agree with that.
Very cool. Well, Christian, I could hold you the whole day, but I'll let you go for your run. It was a real pleasure to see you talk about
Likewise,
so
thank
many.
you, and thank you for inviting me on. I really enjoyed it.
Me too, and I'm looking forward to catching up in person soon. Thank you so much.
Likewise, thank you.